Hey traders, Raghee here. Welcome to July and Charts and Coffee. First show for July. Great to see you all here. I am very excited for this coming month. And again, thanks so much for being part of the Charts and Coffee crew. All right, so I've got a lot of things that are on my list for trades that I would like to see organized today, specifically around the crude oil trade and OPEC. We also have the weekly jobless claims that came out and a little bit better than expected. And what else do we have here going on? So 364 versus 390. We have ISM manufacturing data. Data is going to be very important now that the Federal Reserve has at least cracked the door open to that 2023 timeline to potential, where we would see taper and eventual rate hikes. So every bit of data that reflects on specifically these corners of the economy, jobs, inflation, and growth, but inflation and jobs especially, will actually change the expectations for how soon or how slow we might see that action from the Fed. So we are still in the good news is bad news, especially now. We are still in the good news is bad news type of mindset, or even, bad news is good news. That's another way to look at it. And so we want to continue to see, if you're looking for the market to move higher, you want to see weak to flat data. All right, so that's where we are. That's where we are as we kick off the month of July. And let's get to the questions. By the way, as you can see, NASDAQ, S&P, all punching up to, I don't think the NASDAQ hit a slightly higher high. Maybe hit the high area of the previous two sessions. But we are in a kind of stall-ish mode. Now, I put this in the free video, or probably the premium video for futures yesterday, and that is, don't be shocked nor surprised if we see a little bit of a pullback after the window dressing of June. I think we saw most of the window dressing, meaning that exaggerated move where strong names are bought, weak names are sold. I think we saw most of it Monday, but don't be surprised to see sort of a lethargic or even slightly weak July. Sometimes those positions are unwound. And but overall, I'm still quite optimistic. But gosh, would I love a pullback? I'm still bullish. The pullback is the blue light special. So let's see what is on everyone's mind. Let's start it off. Hey there, Alex. Stalking American Express, right? One of the relative outperformers within the XLF. This is sort of the lingo of our sector secrets mastery, where we're looking at these pre-curated groups, otherwise known as ETFs, that have the high concentration weighting of certain names. And while I may not love financials in terms of, like you said, the tide, American Express, SPGI, even Schwab look pretty darn good. So, right, I'm not crazy about the tide either. That's definitely a problem. We are 3 weeks before earnings, so we are still in that 642 window to earnings, where I like to see the market rally if it's double green. Now, the other thing that I do, and we won't get time to get into it today, and probably in the next few days, we're going to have to start looking at this a little bit more, is Estimize, right? So let's say I'm looking at American Express. And Estimize is a free website, although they do have a subscription-based service as well now. But I want to start taking a look at what the consensus and what the it's a little bit different if you've been using Estimize, because I've been talking about this service for years. I want to get an idea what the Wall Street consensus is, what the whisper number, which is what Estimize is so great at. It's almost like a new generation force rank for those of you that have been around for a few decades. Remember those force rank numbers. And that's what I'm really interested in. Is that number increasing? Where is it in relation to the consensus? And that's what's going to be the best way to understand what's being factored into price now in front of earnings. I know that's a lot to throw at you guys before the caffeine is kicked in, but that's the way you've got to understand earnings. What is that chasm between Wall Street's consensus, the company guidance, whisper numbers, and the trend that all of that is occurring in? By the way, there is a breakdown of this process. It's not as complicated as it sounds. It's called the 642 earnings, and it's available in my Countdown Trader blog. Head on over to countdowntrader.com and you can check that out. And we are absolutely in that window. And I am looking for certain relative outperforming components of XLF to move higher. Absolutely, Alex. All right, James, how you doing, my friend? When looking at a breakout in a narrow range, do I position size mostly from the conservative level, looking at RKT? Okay, so I have an environment that every one of the positions or the types of trades that I'm looking at tend to do best in. In other words, use the right club for the shot, right? We know this. We put snow tires on our cars in the winter because that's the tire for the environment. We know this in all aspects of our life, but somehow when it comes to trading, we sort of stick with our favorites, right? Every environment is not a trend following environment. I've got to acknowledge the environment. This is a sideways market, hence the breakout. I don't love RKT, James, I got to say, because it's been moving sideways for a really long time. My favorite type of consolidation is the type that occurs within an overall direction. In other words, let's say we've had mostly double green or double red. And by the way, that's my lingo for the structure of the 8, 13, 21, and 34 EMAs, reflecting the sentiment, momentum, and finally trend of a market. And that's sitting at the bottom of the chart with those two colored rows. We color code, I color code everything. Makes it easy, makes it objective. Anyways, I like where your head's at, but I don't have high hopes for this one just to break out all of a sudden and do like it did back in here. However, yes, once we have the requisite number of blue grab candles, where would I enter from? Right, cut the range in half, focus on the lower half, as close as you can be to the lower half or the lower level of the consolidation, which you could use the wave, you could use our automated Darvis. For sure, that's where the cost is lower and thereby the cost factor of risk is lower, right? The less you spend on an option, right, there is a component of cost that's related to risk. You trade a $3 option, very different risk component compared to a $30 option, okay? Now, that $3 option can be as risky as the 30 if you buy 10 of them, which is to say what you spend, your budget, as I like to call it, your budget for your trade is going to dictate a huge part of your risk. So follow-up questions when looking for a possible breakout. Do we build most of it from the bottom of the wave? I would say the middle to bottom. Yes, James. And by the way, all these ideas are ideas that we talk about a lot in the Sector Secrets Mastery. So feel free to check out what we're doing over there at simpletrading.com/sector. All right, what is my feeling about using Auto Chartist to supplement option trading? When? Auto Chartist. So those of you that are not familiar with Auto Chartist, here, let me bring it up. So, all my cards on the table, I have worked with and been, involved with Auto Chartist in one way or another for well over a decade. And so this is a tool that many of you have seen me use in the past. I still use it. It's a huge part of what I do. And what it does is it scans for chart patterns for those of you that like that. But the thing that I use, which was first called Power Stats. In fact, if you checked out, I think my third book, 2009, maybe 12, I don't remember. It's been a minute, but I started introducing the concept of using volatility to project support and resistance because finally we had this data from Auto Chartist, this historical 6-month historical volatility data. We could run that through very simple arithmetic processes to project highs and lows. And a lot of you will see those on my chart. This is a process that I created using that data from Auto Chartist. So you need the data to run the numbers. And I guess it's been about, I don't know, however many years, 8 years, where we kind of been projecting support and resistance zones using that data. Okay, so fast forward back to auto chartists. Can you do that for options trading? Options traders, absolutely. In fact, I'll go so far as to say I don't know how options traders can really accurately understand volatility. I know there's IV percentile and IV implied volatility, but here's the thing with that, and I don't want to get into like the deep confusion of it. That's a good data set to start with, but it's actually skewed. So IV percentile and IV, think about when it's reset. When's the last time you thought how it's all relative, right? Anything that's going to compare volatility, in this case, a percentile or the IV, it's relative, but relative to what? It's relative to historical volatility, which is usually reset every year. So that means if you have, let's say in February, and we've seen a couple years in the past where February becomes just bananas in terms of volatility. Imagine then volatility being like a sweater that you stretched out. And you can run it through the dryer and you can do all the trick. It just never is the same again until you get a new sweater. IV volatility is kind of that way with the traditional methodology that options traders have built into their platforms. Once it's stretched out earlier in the year, it's kind of skewed because it's always comparing back to that stretched out zone. I'm kind of using simple, very simplistic ways to look at that. Is it helpful? Yes. Is it accurate? Depends on if that sweater got stretched out, if you will. Because if we had early in the year volatility, now it's always being compared to that. When in reality, I want it to be more rolling and reactive to a set look back. You guys already know this because you do this with your moving averages. Use a 21 exponential moving average. It's 21. It rolls with that 21 data set, that 21 window. That's what I like to do with volatility. And for me, it's a 6-month window. And that's what Auto Chartist does. So what is it for options trading? My gosh, I really don't know how traders would accurately understand. And I traded for a great deal of my trading career, probably 2/3 of it before this data was available to me, just under 2/3. And I know how much more accurate my assessment of where support and resistance are, volatility, etc., since I've had this data. So what is my feeling about it? It's heck yes, Win. Absolutely. And by the way, before you think, oh gosh, well, how much is it, Rog? I pay for it too. It's $145 a year. It's very, very inexpensive. Okay. All right. So Shack, my thoughts on Shack. Sure. I haven't been there in a really long time. I do enjoy a nice burger. It's moved higher, as you can see, through, as you can see right there, through the wave. I would say it probably completed kind of an ugly 1, 2, 3 wave reversal. I'd like a little bit of a pullback here, but it's still choppy. The gap is probably as much in play right now as anything else, but I don't have anything really that I would say other than it looks like the path of least resistance is going to continue to be higher, but I don't have the clarity in the structure of the market through those 4 EMAs that I like to use. So I'd say, put it on the back burner, pay attention to the gap. But Mark, yeah, I don't see anything where I really love, if I get a pullback, towards 100, that century level could be important. There'll be size waiting there for sure. But I don't like it as much as, say, markets that are still in the range where I could fade the higher or lower part of that range, or markets that are clearly in a trend. This is sort of stuck, right? Or this is not stuck. This is transitioning between those two. So I think it's transitioning to more bullishness, but it's not quite, committed yet. Next up, Schlumberger seems to be weak compared to other stocks in the sector. Am I still bullish this stock? Yes. So some of you might have thought my choice of Schlumberger within the OIH might have been a little quirky. It looks just like the OIH because Schlumberger and Halliburton, SLB and HAL, are your number 1 and 2 stocks weighted within the oil services. So it looks just like oil services. And oil services generally is a little bit weak. But what I liked about it is that it was sitting at the bottom part of its range. And that gave us a little bit of an edge in terms of cost. And if there is a floor from which we're going to bounce, that would be just as good a level as any. Now, why Schlumberger instead of OIH or HAL? I could have gone with HAL as well. OIH is just a more expensive way to play it. And so it was really a 6 of one, half dozen the other between Schlumberger or OIH. But keep in mind, we can talk about technicals all we want. The fact of the matter is OPEC is going to rule the day in terms of oil stocks and oil. And I am anticipating the market to be a little volatile as we get the messaging from OPEC that they are going to ease production cuts some. That's already well discounted into the market. There is anticipation that they're going to increase some of the output or ease the production cuts, however you want to look at. We're going to see more supply hitting the market. What's going to be really important for OPEC is to thread the needle in the message. Are they going to be able to communicate confidently, clearly, that the output increase is needed because of an anticipated supply shortfall of about 1.5 million barrels per day come August? And so they're trying to be preemptive about that. If they can communicate that clearly, look at crude oil. I think they've done well. Gold star for OPEC. I do anticipate oil stocks to follow suit. Okay. So, terrific continued uptrend on crude. Energies are probably some of the best corners of the market in any asset class. So whether you're talking commodities, equities, ETFs, probably some of the strongest trends right now are in energy, and the knock-on effect would be who would benefit from that? That would be oil stocks. Okay, so I am bullish. Yes. Netflix, sure. I have no skin in the game in Netflix. Just putting it out there. Gapped higher. There's a vacuum now that we've entered, and that's the vacuum of the gap. And I would anticipate that 550 will be resistance for Netflix. And it's also going to be sort of gravitational pull. Gaps like to be closed. And once we enter that window, now, might we close this gap to the downside before we go to the upside? That would be a cool entry, right? That would be, so on the way to closing this larger gap, could we just head down and close this smaller gap? That would be fantastic, because that would give us not a trend following entry. The grab candles are green. Clearly, we have bullish momentum. We don't have a bullish trend yet. I think we're heading in that direction. And remember, we've got earnings coming up, and it's starting now. It's inside the 3-week window, but not quite the 2-week window. Where, remember, once we're about 2 weeks into before earnings, the implied volatility starts to move higher and higher, and directional debits are less desirable, and more of a credit collecting approach to earnings makes a lot more sense. So I like to play directional debits. So that's why I like that cutoff of about 2 weeks. So I'm right on the fringe of that, but if we can get a close at a smaller gap to the downside around 520 and then move higher towards that larger, but earnings are really going to dictate. And this takes us right back to more of an earnings methodology. What's the guidance? What's the consensus? What's the whisper? And start to reconcile what's being priced in now. And then how much better is the actual result in revenue and in earnings per share going to have to be to create more of a move? I mean, that's always what it is. It's just our ability to measure that as accurately as possible. All right. Okay. So I'm going to be heading on over to do our weekly Q&A in the Sector Secrets room. So I'm going to have to log off now. But of course, that's our episode of Charts and Coffee. Great to see you all every morning between 9 and 9:20 here at the Simpler Trading YouTube channel. While you're here, subscribe to the channel so you get notification of when the show goes live each morning. Smash that like button on the way out. First of the month. Very excited. 6 more months left in the year. Let's just smash it together. Right? Really looking forward to the next 6 months of this year. Let's just kill it. All right. Have a great one, gang. Be good to each other. I'll talk with you soon.